When you get qualified for a mortgage, one of the biggest pieces of information that we're going to review is your income. We want to make sure that you have the ability to pay the loan back based on the monthly payments and any credit card debt, car loans, student loans, any monthly debts versus what your income is. But there's a couple of different ways to look at income. One is what you actually live on. That's things like your paycheck deposits, including your overtime, commission, bonuses. You could get restricted stock units. That's another part of income. You might have a second job. You might have a little side business. All of these are income amounts that you live on. That's real money to you. But what a mortgage company looks at is called qualifying income. And this is different categories of income that's calculated differently depending on what type of income that it is. So if you get a salary, that's just what the income is. It is the same thing every month based on just what your salary is. It's pretty simple. If you're hourly, that's going to be determined by if you have a set number of hours per week or if it varies a little bit. Anything that varies, we're going to look at a 2-year average. So if you sometimes work 32 hours and then the next week you might work 41 hours and it flips around a little bit, we're going to look at a 2-year average for that, as well as overtime, commission, and bonus income. If you're self-employed, this is also something that we generally look at 2 years history for. So things like that, anything that varies. The other thing that we look at is how long it's going to continue. If you have a job or you're self-employed, we're going to assume that since you've done that for the last couple of years, you're probably going to then do that for however long into the future. But some people have things like alimony or child support, or they might draw income from an asset, so from an IRA or maybe a trust or something like that. And the main thing that you want to remember with that is that it is something that's going to continue for 3 years or longer. Not 2 years and 11 months, but 3 years or longer from the closing date of your loan. So that's definitely something you're going to want to look at with your loan officer. The other thing to know is that some types of income we can increase just on paper. So some types of income is not taxed. And if it's not taxed, we can add a percentage of that amount to your income calculation, and you can actually get credit for a higher amount. And that's because all the other types of income are taxed, and you don't get to actually live off the amount that you start with. It's the amount that after taxed. So things like Social Security is sometimes not taxed, or a portion of it might not be taxed. Also, child support is generally not taxed, and so we add to that amount. And so the income portion of your qualifying for a mortgage is a little bit more complicated than meets the eye. What you need to do is definitely talk to your loan officer and have them do a full income review. This is one reason why it's a really good idea to have an actual human loan officer with lots of experience that can know all these income types rather than just typing your information into an online app. The online app doesn't go through the income types and all the calculations with you. So please call me if you need help with this. We have lots of experience and we can review with you and help you get qualified for the right mortgage. Hope you have a great day. If you like these videos, please like, subscribe, and comment. We'd love to see you again.